When we talk about innovation, design, and consumer loyalty in the 21st century, one name echoes across the world: Apple Incorporated. This isn't just a tech company. It's a cultural phenomenon. Whether it's the iPhone in your pocket, the MacBook on your desk, or the Apple Watch on your wrist, Apple has become an integral part of modern life. But beyond the sleek product design and premium branding lies a financial engine that has consistently delivered for its shareholders over decades. Today, we're diving deep into Apple's stock, unpacking its core metrics, performance, and everything you need to know before deciding whether to invest. If you had invested $1,000 in Apple years ago, you'd be looking at a small fortune today. But is it still a buy? Let's break it down. Apple's fundamental metrics give us a window into its core profitability and business strength. Earnings per share, EPS. Apple's current trailing EPS is around $6.43. That might seem like just a number, but it reflects massive net earnings, divided across billions of outstanding shares. EPS is a vital measure of profitability, and in Apple's case, it's consistently strong and growing. P/E ratio, price to earnings. Apple trades at a P/E ratio of around 28. While that's higher than the S&P 500 average, investors are often willing to pay a premium for quality, consistency, and leadership, traits Apple has in spades. A higher P/E reflects market confidence in future earnings growth. Revenue. In the most recent fiscal year, Apple brought in over $383 billion in revenue. Think about that. More than the GDP of some countries. This isn't just from iPhone sales. Services like iCloud, Apple Music, and App Store transactions are a growing share of the pie. Net income. Apple's net income is above $97 billion annually. That level of profitability is nearly unmatched. It speaks volumes about efficient operations, high product margins, and smart cost management. Dividend yield. Apple pays a modest dividend, currently around 0.5% yield. It's not a dividend growth stock in the traditional sense, but it does offer stability and small returns to income-focused investors. Importantly, Apple has a consistent history of increasing its dividend over time. Investing isn't just about income, it's about stability, and Apple shines here too. Debt-to-equity ratio. Apple's D/E ratio is approximately 1.7. While it has taken on debt in recent years, largely to fund buybacks and dividends, the company still has more than enough cash to cover liabilities. It's using debt strategically, not out of necessity. Current ratio. The current ratio sits around 0.88. At first glance, that might seem low, but Apple's operational cash flow is so strong that short-term liabilities are rarely a concern. This is a case where raw numbers don't tell the whole story. Free cash flow, FCF. Apple's free cash flow is a jaw-dropping $111 billion. That's after all expenses, taxes, and capital expenditures. This is the cash used for dividends, share buybacks, R&D, and acquisitions. Essentially, this is Apple's war chest. A strong past is one thing, but investors want to know about growth potential. Revenue growth. Over the past 5 years, Apple has maintained a compound annual growth rate, CAGR, of around 10%. That's impressive for a company of its size and shows it hasn't reached a saturation point yet. Earnings growth. Apple's EPS growth has been steady, with a 5-year CAGR of about 11%. Much of this comes from strong service revenue, aggressive share repurchase programs, and expanding margins. Market cap. As of May 2025, Apple's market cap sits at over $2.8 trillion, making it the most valuable publicly traded company in the world. That's not just a flex, it's a sign of massive investor confidence and widespread institutional ownership. Now let's talk about whether Apple is worth the price you pay. Price-to-book ratio, PB. Apple's PB ratio is around 47, far above traditional benchmarks. Why so high? Because Apple's value lies not in physical assets, but in brand power, software ecosystems, and customer loyalty, intangibles that don't show up on the balance sheet. PEG ratio, price/earnings to growth. The PEG ratio is around 2.1. A PEG ratio over 1 typically suggests overvaluation relative to earnings growth. However, Apple tends to command a premium valuation, because it's not just another tech company, it's the tech company. Investors also want to understand volatility and stock price behavior. Beta. Apple's beta is around 1.3. That means it's slightly more volatile than the overall market, which is expected for a tech stock. But Apple's drawdowns tend to recover faster, largely due to investor trust and strong fundamentals. 52-week high/low. Over the past year, Apple has traded between $148 and $199. The current price is near the higher end, reflecting market optimism and strong quarterly results. Buying at a 52-week high can feel risky, but with Apple, highs often lead to new highs. Personal analysis and comments. From a personal investment standpoint, Apple is one of those rare companies that blends value, growth, and reliability. If I had to choose a single stock to hold for the next decade, Apple would make the shortlist. Why? Because it's not just about products, it's about an entire ecosystem that locks users in and keeps competitors out. The iPhone is just the gateway. From there, users buy Apple Watches, subscribe to Apple TV+, store photos in iCloud, and pay with Apple Pay. Every interaction builds loyalty and recurring revenue. And that recurring revenue, especially from services, has higher margins than hardware. What really sets Apple apart, in my view, isn't just the revenue numbers or the profit margins. It's the emotional connection the company has built with consumers. You can't quantify it on a balance sheet, but it's real and powerful. When people buy an iPhone, they're not just buying a phone, they're buying status, design, simplicity, and reliability. That emotional loyalty is what keeps people coming back year after year, upgrading, subscribing, engaging. From a business standpoint, that's a moat you can't easily replicate. Now, let's talk about Apple's capital return strategy, because this is a big deal for long-term investors. Apple is arguably one of the most shareholder-friendly companies out there. Every year, they return tens of billions of dollars to shareholders through dividends and share repurchases. Their stock buyback program is one of the largest in corporate history. That means every time Apple buys back its own stock, your share of the company becomes more valuable, even if you don't lift a finger. That's passive wealth growth at work. Looking at product diversification, Apple isn't just about the iPhone anymore. The Mac lineup has gotten a massive boost thanks to their in-house silicon, M1, M2, and now M3 chips. That vertical integration is cutting costs and increasing performance, which boosts profit margins. Meanwhile, the iPad continues to dominate in the tablet space, and Apple Watch has carved out its niche in health and fitness. But the real dark horse here is services. Services include Apple Music, iCloud, Apple Care, the App Store, Fitness Plus, TV Plus, and more. This segment alone generates over $90 billion annually, and it's growing faster than hardware. The best part? Services revenue is recurring. Unlike a one-time iPhone sale, people pay monthly or yearly. And because of that, Apple's revenue base becomes more predictable, more stable, and more scalable. There's also the ecosystem effect. The more Apple products you own, the harder it is to leave. If you have a MacBook, you're probably using an iPhone. If you're on iPhone, you may also have AirPods or an Apple Watch. It all just works together. And that stickiness keeps customers, and revenue, coming back. In the investment world, that's known as a competitive moat, and Apple's is one of the widest and deepest. International growth is another major story. While North America still leads in revenue, Apple is making strong inroads in India, Southeast Asia, and Latin America. These are markets with huge populations and rising middle classes. In India, for example, Apple just opened its first retail stores, and they're building out local supply chains. That could unlock the next billion-dollar growth phase. Now, let's pivot briefly to risk factors, because no company is perfect. One challenge Apple faces is regulatory pressure, especially around App Store practices and monopolistic concerns. Governments in the EU and US are keeping a close eye. Any major regulatory shakeup could impact Apple's highly profitable services segment. There's also supply chain dependence, particularly on China. Political tensions or COVID-related shutdowns could disrupt production. That said, Apple has started diversifying into India and Vietnam, so it's taking this seriously. Another risk? Innovation fatigue. Critics argue that Apple isn't innovating like it once did. No new category-defining products have emerged since the Apple Watch. But I'd argue that Apple doesn't chase trends, it perfects them. And with whispers of AR/VR headsets and electric vehicles in the pipeline, the next big thing might be closer than we think. Let's revisit the valuation question, because this comes up often. Is Apple too expensive right now? Should you wait for a dip? The truth is, great companies rarely trade at cheap valuations. If you always wait for the perfect price, you may miss the long-term ride. Apple isn't just a stock, it's a wealth-building machine. Yes, it's had corrections. But historically, every dip has been a buying opportunity. Look at any 5-year or 10-year chart. It's a textbook example of compounding returns. Dollar cost averaging, DCA, can be a great approach here. Instead of trying to time the market, You invest a fixed amount each month. That way, you accumulate shares over time and smooth out volatility. For long-term investors, this strategy works incredibly well with a stock like Apple. One more thing I love about Apple as a stock: it's a great core holding. It provides exposure to tech, consumer goods, global growth, and innovation, all in one company. Whether you're building a new portfolio or rebalancing an existing one, Apple fits in almost any strategy: growth, income, thanks to dividends, or even low volatility portfolios. Apple also has an X factor that's hard to put into metrics: the leadership under Tim Cook. Say what you want, but since taking over from Steve Jobs, Cook has grown the company's market cap by trillions, transitioned the product line to in-house chips, expanded the services empire, and maintained one of the highest profit margins in tech. That's execution at the highest level. And when it comes to future growth potential, Apple is just getting started. Imagine what happens when they fully tap into AI, when they launch Apple Vision Pro at scale, or when the Apple Car rolls out, if it happens. Each of these projects represents multi-billion-dollar opportunities. Even if only one or two succeed, they could add massive upside to the stock. So, to wrap this all up, Apple isn't just another stock pick. It's a cornerstone. It's the kind of company you can hold through economic cycles, market crashes, tech booms, and global events. It's not immune to volatility, but it is resilient. And in a world full of uncertainty, that matters. If you're thinking about buying Apple, don't overthink the day-to-day price action. Focus on the fundamentals. Look at the financial health, the cash flow, the growth metrics, the valuation, and, most importantly, the company's ability to innovate and dominate over time. Apple has proven, again and again, that it knows how to deliver, to customers, to employees, and to investors. If you believe in long-term investing, and you want to own a piece of the future, Apple deserves a place in your portfolio.